So here we have our standard cost sheet. You'll see it has the three sections: direct materials, direct labor, and overhead. In the column, it gives us a description of what it is that we're measuring. In the next column, it gives the standard price. That's the price it's costing us for that material, the labor, or the overhead. What the standard usage is per product. So in this case, with yellow corn, it costs us a penny for it, and we use 18 ounces of it. So we multiply that together. That gives us the standard cost of 18 cents. I'll skip down to direct labor. Same thing for inspection. Costs us $8 an hour. We need 0.01 hours per product. Costs us 8 cents. I'll skip down to overhead. Same thing there. We must have calculated the variable overhead previously to be $4 an hour. We need 0.02 hours per product. That gives us 8 cents. So we go through those calculations for all three categories. It gives us the subtotals for each of those categories. We add them all together to get the total standard cost per unit. So here all the direct materials equaled 32 cents per unit. Total direct labor, 18 cents per unit. The total overhead was 38 cents per unit. We add that all together. The total standard unit cost in this case is 88 cents per unit. And you could apply this to any number of things in manufacturing. So when we were talking about budgeting last week, we talked about unfavorable and favorable variances. The same is going to apply when we're looking at standard product costing. If variance comes in under budget, that's favorable. If we're over budget or the expectation or the standard, that's unfavorable. So if a variance is favorable or unfavorable, we're going to want to know why that is. So as with any investigation, we have to determine if the time and cost to investigate the variance will be less than what will be achieved by knowing the results of the investigation. So as managers, you have 1,000 things to do all day. You probably can't be looking at all of these standard costs on an individual basis with any regularity. So you place control limits around them. And we know that with budgets or with standard product costs that will probably vary from what the standard set is. So just simply investigating every variance wouldn't do us any good. So by setting the control limit and creating a range of acceptable variation, if something falls within that range, we assume that it's just caused by chance or random factors. The acceptable range is the standard plus or minus the allowable tolerance. So if something exceeds the control limit one way or another, hopefully we'll have some type of enterprise accounting system that'll automatically prompt us that something has fallen outside of the control limit that is set. This can be through reports that are generated by the system or some type of automatic prompting. So this just gives us an example of standard cost was set at $100,000. We figured out that the standard deviation is plus or minus 10,000. And so if we look at the standard product costs over these 6 months, only one of the months, November, falls outside of the control limit set. So when we ran a report for November, hopefully that would come up, or we'd automatically get an email saying that the standard cost has exceeded the normal allowable deviation for that month. So when we look at this in the context of labor efficiency, we have production managers who are responsible for delegating how labor is used in the organization. And once something is discovered outside of the normal control, we have to figure out what happened? Were we short-staffed? Did production needs increase? Were we just simply not being as efficient as we were before? Was there some type of distraction during the production process? Could be any number of factors. And it points out here that if we set incentives based on labor efficiency, then there's the potential for a production manager to engage in some type of nefarious behavior to make things look like they're more efficient than they actually are. So one example it gives here is if during the quality control process they discover a unit is not up to standards, rather than having employees go back and redo that unit or make necessary repairs to it, if we're monitoring simply how many hours it's taking us during the production process and we're paid based on that, then the production manager might just transfer this device into finished goods, say there are no quality control issues with it, and that it should be sold, and then eventually that product will be returned. So if you as a manager determine that there's some type of significant variance in labor efficiency, it's either taking us longer than expected or a lot less time than expected, then we need to find out why. Why might something take us less time than we expected it to? Well, maybe we're not recording our hours properly. Maybe we have become more efficient through some type of automation. Maybe they aren't following the proper quality control process as we just described before, and materials are being transferred to finished goods prematurely, and then we'll have a higher rate of return on the back end. So any type of labor efficiency variance that falls outside of the control range should be investigated, and then you could take necessary action based on the results of that investigation.